Welcome to the Deep Dive. We're here to cut through the noise and give you clear insights. There's this quote that keeps echoing for me.
Oh, yeah. Which one?
It's from Chuck Prince, the Citigroup CEO, back in 2007. Right before things went sideways, he said something like, as long as the music is playing, you've got to get up and dance.
Yeah, that definitely feels relevant now because we're seeing private equity PE, which used to be just for, the big pension funds and endowments.
Right, the institutions.
Exactly. Now it's being sold hard to everyday folks like you, sometimes even inside your 401k or target date funds.
Okay, so that's our mission for this deep dive then.
Yeah.
Let's unpack what PE actually is, understand how it got so big, and figure out why it might be, well, maybe not what it seems for you, the average investor. Let's start there. What exactly is private equity?
Sure. So basically, private equity firms buy companies that aren't listed on the stock market. They often buy the whole company or a big chunk of it.
And they use a lot of debt to do it.
Right.
Leverage.
A lot of debt, typically. That's key. Then they try to restructure the company, maybe cut costs, maybe add more debt, streamline things with the goal of selling it or flipping it for a profit, usually within, say, 3 to 7 years.
Okay. And how did this whole thing become such a behemoth in finance?
Well, the big shift really happened after the 2008 crisis. Interest rates went to practically zero.
Right. So traditional bonds weren't paying anything.
Exactly. So huge investors like the California Pension Fund, CalPERS, started pouring money into these alternatives, looking for better returns. Their CIO even said, we need more of it now. That really kicked off a frenzy.
A frenzy is right. I saw deal volume hit something like $3.1 trillion globally in 2021.
Yeah, it was massive. And the prices they paid, the valuations, they almost doubled. Went from maybe 6.5 times a company's operating profit, the EBITDA, back in 2009, up to like 12 times by 2022. But now interest rates are up, the easy money's gone, so the big sophisticated players are more cautious. And who's Wall Street turning to?
Us, the retail investors.
You got it.
Yeah.
Which should immediately make you ask, okay, what are the risks here for me?
Let's get into that. What's the first big one? I hear illiquidity a lot.
That's a huge one. Illiquidity. PE funds typically lock your money up for, say, 7 to 10 years, sometimes even longer.
7 to 10 years.
Yeah. So you lose all flexibility. If you need that money for an emergency, a house, anything, or even if the market tanks and you want to reallocate, you can't. Think about the COVID crash in 2020. If your money was in PE, you just had to sit there.
Okay, so you're locked in. That's risk number one.
Yeah.
What about just knowing what you own? Public stocks, you see the price every second. PE seems kind of murky.
That's opacity, the second big risk. It's definitely murky. Unlike public markets, PE valuations are subjective. They use internal models, update them maybe quarterly, maybe less.
So not real-time market prices.
Not at all. This makes the returns look really smooth on paper. It creates this illusion of low risk, low volatility. Like in 2022, public stocks plunged double digits down.
Yeah, brutal year.
Right. But many PE funds reported barely any losses, tiny markdowns. It just doesn't reflect the reality of what was happening in the broader market. It masks the risk.
Okay, locked in, can't really see the value. And then there are the fees. I've heard this 2 and 20 thing. Sounds expensive.
It is very expensive. 2 and 20 means they charge you a 2% management fee every single year on your total investment, plus 20% of any profits above a certain level, the hurdle rate.
Wait, 2% a year. So on $100,000, that's $2,000 a year, every year, for 10 years. That's $20,000 just in management fees.
Exactly. And that's before they take their 20% cut of the profits, if any. Compare that to an S&P 500 index fund ETF that might cost you, 0.03% a year?
Wow, that's a massive difference. Do the returns even justify those fees?
Often no. After you subtract all those fees, studies show many PE funds actually underperform simple, cheap public index funds. You're paying a premium price for often mediocre results.
Okay, and the leverage, the debt we talked about earlier, that must add another layer of risk, especially now.
Definitely. It's the amplifier. Using lots of debt, maybe 5 to 7 times operating profit, juices returns when things go well and rates are low. But when borrowing costs rise, like now, it makes those companies incredibly fragile.
So companies bought in, say, 2020 or 2021 at those peak prices with lots of debt.
They're facing a potential nightmare trying to refinance that debt at much higher rates now. Big risk.
It sounds like there are a lot of hidden dangers. Are experts flagging specific warning signs right now?
They are. The CFA Institute, for example, points out several red flags. One big one is just inflated valuations. Many PE values are based on optimistic projections, not real market sales.
An illusion of stability again.
Exactly. And get this, some data suggests around 65% of individual PE deals either fail completely or only just return the original money invested.
65%. That's,
Yeah.
wow. That's not a great track record.
Not exactly confidence-inspiring, is it? Then there's the problem of frozen exit markets.
Meaning it's harder for the PE firms to sell the companies they own.
Precisely. Higher rates, lower public market values. It means fewer companies going public through IPOs, fewer buyouts. So the PE firms are stuck holding these companies longer.
Which means delays for investors getting their money back.
Yes, delayed payouts, longer lockups than planned, and maybe even being forced to sell companies cheap just to get some money back to investors.
Are we seeing signs of that pressure already?
Absolutely. Look at the secondary market where existing PE fund stakes are bought and sold. They're trading at big discounts like 20%, sometimes even 40% below their stated value.
So even the pros are taking big haircuts just to get out.
It's a clear sign they think the stated values are too high or they desperately need liquidity. And one more thing, dry powder FOMO.
Dry powder. Sounds like potential trouble. What's that?
It's the record amount of cash that PE firms have raised but haven't invested yet. Trillions of dollars. That creates huge pressure internally to do deals, to put that money to work quickly. And that pressure can lead to rushing into bad investments or overpaying for companies. History shows that funds raised at the peak of these cycles, like 2007 or 2021, often deliver the worst returns.
Okay, this is a lot to take in. So for you, listening right now, maybe seeing PE pop up as an option in your retirement plan, what are the practical steps? What can you actually do?
First step, know what you own. Really dig into your retirement plan, especially those target date funds. Sometimes PE exposure is buried deep in the fine print.
Okay, check the holdings. What else?
Prioritize liquidity. Think about favoring investments where you can actually get your money out when you need it, ideally daily.
Right.
Low-cost index funds, ETFs, that access is a powerful risk control.
And it comes back to transparency and those fees, right?
Absolutely. Demand clear reporting that shows performance after all fees are taken out. Net of fee returns are what matter to your bottom line. And ask yourself, if this private thing costs 2% or 3% a year versus 0.1% for an index fund, is it realistically going to deliver enough extra return to justify that massive cost?
Usually not, based on what you said.
Usually not, especially consistently over time. Which leads to the final point. Keep it simple, stay diversified. Decades of evidence support sticking with a well-diversified mix of straightforward, liquid, low-cost public investments. It works.
Right. So wrapping this up, it sounds like PE might have a role for huge institutions with very long timelines and diversification needs.
Maybe. For them, it's a small piece of a giant puzzle.
But for you, the average investor, the lack of transparency, the long lockups, the high fees, those risks are much, much bigger. And the benefits are often captured by the managers, not by you.
Well said. You know, Wall Street loves selling the next hot thing, often right when the party's about to end. If that music does stop for private equity, like Prince warned, you really don't want to be the one left on the dance floor holding the bag.
A sobering thought. Stick to the basics. Transparency, liquidity, low cost, and discipline. That seems like the surest path.
Couldn't agree more. Keep it simple, keep it clear.